All right, hedge funds now manage about $1.5 trillion in assets, that according to Barclay Hedge, up about 24% from its lowest point last April. All this as the Justice Department investigates whether hedge funds were responsible for a drop in the euro.
Ridiculous.
It is ridiculous. Are hedge funds a good alternative to equities, or are they the ultimate boogeyman? That is today's Call the Wild.
I could be wrong.
Let's bring in John Carney, managing editor of BusinessInsider.com, and Bernard Whitman, CEO of Whitman Inside Strategies. Good morning, gentlemen. So, Bernard, let me start with you because you think the hedge funds are boogeyman. I thought that the problems with the euro came from Greece's default and their debt ratios and their debt problems and their public strikes. But you're saying it was really all about the hedge funds.
Larry, completely overstate my position. I think that given
we always do that.
That's what I expect here. But given hedge funds' demonstrated ability to potentially inflict widespread disruption in the global economy, I absolutely believe that we need the tools and oversight necessary to properly regulate this rather opaque industry. Now, having said that, I absolutely reject the calls from some on the far left that suggest that hedge funds are to blame for all of the nation's ills, all of the downfalls in the global economy. I think that's a stretch. I think that's placing too much blame on the hedge funds and really giving them too much credit for the economic downturn.
But haven't all the conspiracy theories gotten a little bit ridiculous? I mean, John Carney, I'm sure you saw all these articles about this super meeting of hedge funds in Midtown Manhattan, you know, in some townhouse, and they all got together and they had this thought dinner where they talked about what to do next, and out of that came this idea that the euro was going to tank and we're going to all go out and short it, and then this group was able to tank an entire global currency. Is that even possible?
It's completely ridiculous. In the first place, the euro was already tanking long before the meeting took place. It took place in a restaurant. It wasn't a secret meeting.
Oh, really? No townhouse? That's so disappointing.
No, it was a restaurant called a townhouse.
Oh.
And tape recordings were made. Somebody produced a research report based on the meetings. This was more like...
Sounds more boring.
Yes, well, it's a lot more boring, which is the reason why, when the Wall Street Journal wrote it up, they went with the more scandal-ridden way.
Yeah, but you know,
probably
John,
sells more paper.
Just as a sidelight of this meeting, guess what? The euro has stopped falling. I mean, since this meeting, the euro has stopped falling.
Right. These guys aren't as powerful
maybe they
as
had
they're
another
supposed to be, I guess.
and we don't know about it. They got together again.
No, but that's my point, Bernard. Look, hedge funds have a lot of very brilliant people. They also have some not so brilliant people, and sometimes you can make the wrong call. So in a free market setting, why do we even care? It's all going to even out. It'll be what it's going to be.
I tell you why we care, because they have an ability to cause wild swings. They could sustain, they can get billions of dollars of losses in a week, which can dramatically gouge people's retirements. I think we are looking at a minimum level of oversight. Number one, I think that the agreement to require hedge fund managers to be listed makes basic sense. The hedge fund industry has agreed to this. I think that it makes great sense to require hedge funds to give at least a high-level overview of their exposure to stocks and bonds and borrowing by banks. But I think if you look at something like the Volcker rule, which would prohibit any proprietary investment from banks' funds into their own investing, I think that we ought to decide that on a case-by-case basis.
What about taxing them? What about taxing them, John Carney? You know, part of Obamonomics is to change the tax structure of the hedge funds, make them pay up on the top personal rate, right, which is going to 40, no more capital gains. What do you make of that, John? That's part of this punitive class warfare against hedge funds.
It's a big mistake. These are actual real capital gains, and what they're trying to do is describe capital gains as income just to get money from these guys. It's really just a political war. I don't even think they actually expect to ever raise the taxes. What they hope to do is get some campaign cash out of these guys by threatening to raise their taxes.
Wow, you are really cynical, John. You're really cynical. I like that. What about the idea that the shadow banking community and the trading of derivatives is in fact responsible for a lot of what happened, and hedge funds play a big part, a big role in that? I mean, there's something to that argument, and we haven't seen big changes in regulation.
Well, here's the thing with that argument. I remember before the financial crisis struck, everybody only talked about the systemic risk posed by hedge funds. What happened? It was our banks that blew up, and our Wall Street, our mainstream,
the most heavily regulated sector blew up. The most heavily regulated,
we gotta go,
and the least regulated sector came out pretty good.
All right, gentlemen, thank you so much for joining us. We appreciate it. That's going to do it for us on the call.